Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Jonathan Boss and Judith MacKenzie of Downing ONE VCT. Hello.
Hello.
Perhaps we can start off with you, Jonathan. Could you give me a brief introduction to Downing and also your own role there?
Sure, yeah. So Downing's a fund manager that's been around for 30 years, focused on investing in sort of small and medium businesses, and we have approximately £1 billion under management, of which around a quarter is in venture capital trusts. So we've been doing venture capital trusts since they were invented, I suppose. My role there, I focus on the unquoted investments. I've been at Downing for 9 years, and prior to that I was also investing in SMEs for, over 20 years now at 3i prior to Downing.
And Judith, perhaps a brief introduction to yourself.
I look after the public equity side of the business, and we're investing in small micro-cap companies, growth companies on the AIM market, and also the full list as well. And I've been responsible for the AIM element of the Downing ONE VCT for the last 8 years or so. Prior to that, I've been again investing for over 20 years in small businesses, AIM businesses at Aberdeen Asset and also Electra. So I've been doing it man and boy.
A lot of experience.
Well, sadly, yeah.
And what does the Downing ONE VCT, what does it do for investors?
It's got a great blend of income generating assets and investments and also growth. So a really nice balance, around about 60% in income generating assets and 40% in these growth companies. And that balance will probably continue, around about 50-50 as we go forward with fundraising. So it's quite a mature portfolio in some of the income generating assets, but growth companies that have kind of come through the generations and are now generating a decent yield. So you get a good blend of circa 80 investments and therefore great diversification.
Okay, now it's obviously quite unusual to have two managers managing such a fund and doing two different things. If we actually stick with you, Judith, first of all, what sort of companies are you looking for?
It sounds very boring, but we're looking for sensible management teams that have got a little bit of IP or a niche in their market and that are growing. So we do like companies that are revenue generating. We don't tend to do blue sky tech. However, we certainly invest in growth businesses that are pretty much from early stage right the way through to more mature businesses. But we're backing management teams.
And perhaps you could give me some examples of recent investments you've made.
On the AIM side, we've made, well, maybe one of the older ones actually, because it shows the gestation of an early stage company coming right the way through our investment process. We're good long-term investors, so one of the first investments I made in the trust is still there today, and that's 8 years ago, and it's a company called Traxys, which at the time when we invested had about 300,000 worth of profits. It's now 10 times that and now paying a dividend. So a real growth company which had a solution in the transport space for real timetabling. Sounds like a simple problem, but it's not. And that's a company that, as I say, has grown 10 times in its earnings, and it shows you that you can get some fantastic returns from these growth and embryonic companies as they come through, and hopefully we help them. I think we help them go through that gestation.
Okay. And Jonathan, in terms of how you invest, what sort of companies are you looking for?
Well, one of the things that's interesting is that Judith's approach to investing in quoted businesses is quite like private equity in that it's so management focused, and that's at the core of all of the investments that we make, whether they're in more mature income generating businesses, and historically Downing ONE has invested in businesses like care homes and pubs and conference centres, as well as in renewable energy type businesses, and more recently it's been investing in growth businesses, a mixture of businesses that have kind of long-term recurring revenue, like facilities management businesses, but also newer businesses that perhaps are reaching the point where they are profitable, so they've established their market, they've established a track record, and they now need funding to take them through to the next level.
Okay, and have you got any examples, particular favourite investments you've made
Well,
recently?
so a good recent growth investment is a business called Zoops, which is a difficult one to pronounce. It starts with an X. It's a business that deals in pre-owned and vintage watches. They had established a decent business over 2 or 3 years before we invested in it. And at the point that we made our investment last year, they were at the point where they were breaking even and starting to make profits. And it was very clear by analysing the performance that they'd had that through investing in stock, that was what was holding them back, was their ability to invest in stock, that would unlock further profitable growth. And indeed that's been the case. So we've been staging investments into that business, growing their asset base. And it's been very rewarding to see that our investment thesis coming through in practice.
So that's the type of company you like. Are there any types of companies you avoid?
Well, I guess fundamentally, as I said earlier, it's about backing management teams. So if managers have not proven themselves in the past, then that makes it far more difficult to back them. And this fund is really not about trying to find the next Facebook, trying to find something that's going to increase in value 100-fold over time, although that would be nice. It's far more about finding businesses that have already established a path to profitability, and so it's not about pre-revenue businesses or things of that nature.
And is that the same for you, Judith?
It is really. I mean, we don't like investing in anything that we can't understand within 5 minutes. And it's got to be management teams that have got decent skin in the game, just as Jonathan says. And we're not geologists, so we don't invest in holes in the ground or blue sky tech. But there are lots of decent companies out there that we can invest in. It just because we're narrowing our remit down slightly doesn't mean that we're restricted too much in what we're looking at.
And is there anything you would in particular avoid?
Yeah, management teams that can't demonstrate a track record, whether it be in their own company as of today or previously. So we are looking for, we're backing management.
Okay. And are you actually finding with AIM, some people say there's a bubble? Do you hold with that? Especially there's a lot of IHT money pouring into it.
Yeah, I do believe that. And we have soft closed our IHT fund for that reason. And we've got one of the largest teams that hunt the AIM market, microcap market. And a lot of our deal flow into Downing One is proprietary deal flow. It's not necessarily coming from the brokers. But we've got to have a team of 5 of us doing that. We can't just depend on the market to throw things out for us. So yes, it's hard, but we've adapted.
Okay. And talking of adapting, the rules changed in 2015, make it much harder to choose investments. How's that affected Downing One?
The rules change for VCT investing from time to time as government seeks to focus the tax relief where it wants to do and properly so. I guess we've been investing in Downing One for over 10 years and the rules have changed several times in that period. In fact, the genesis of Downing One was a fund that was entirely focused on care homes, and there are still care homes within the portfolio that are very nicely yield generating businesses, but the rules changed to stop that fairly quickly after its inception. So we go out and we seek to find businesses that match what we want to do, that fit within the current rules. And like Judith, we've got a decent sized team of people who focus on particular sectors, who try and work with the best management teams to establish a deal flow that keeps on delivering year in, year out. So backing people time and time again to do good businesses that we understand.
Okay. And in terms of exits, do you have a particular strategy, or is it try and buy these companies and hold them for as long as possible?
Our strategy is driven by the fundamentals of each business. So the fund is an evergreen fund. There's no particular time horizon by which we have to exit. We're driven more by producing income and growth than we are by chasing IRRs. And so we look at each individual business and decide whether it is still on a growth track, whether it's delivering a good yield against what we might be able to realise for it. And a good example of a decision that we made recently, which ultimately led to an exit, was a team whom we'd backed probably 5 years ago now, Kidspace. They operate indoor and outdoor children's play centres. Been a really successful investment for us, building some new facilities for them, and we were keen to continue to back that growth, but they were unable to find sites that offered the same potential for return, and when they got knocked back on planning for one that we were all keen to do, they ultimately couldn't get planning, and we formed the view together with management that that was an opportunity actually to say, well, we'll focus on something else. We'll go for an exit. We'll sell that business, and we'll move on and redeploy that capital elsewhere.
And there's lots of money going into VCTs this year. There'll be a lot of people who've been affected by pension restrictions, etc., who probably haven't invested in this sort of thing before. It's pretty risky, isn't it? So what do you do to minimise those risks?
Well, on the AIM side, we've got a slightly different approach to maybe some of the mainstream managers. We've got quite a concentrated portfolio. When I say concentrated, it's still diversified, 25, 30 stocks. We've got 5 of us looking after it. So therefore, our diligence in the way in, I think we take longer doing diligence in the way in, and our portfolio management is quite hands-on. We like to take what we regard as sort of relatively strategic stakes in companies. So we really are working with that management team over the long term, a bit like private equity, where we've got maybe a stake 10, 25% sometimes, and that allows us to be a bit more master of our own destiny and direct the company towards a trade exit. As long as we have an aligned management team, they tend to want to go for that after 3-5 years. So that helps mitigate the risk, I think, from our perspective.
And I think in the spectrum of VCT qualifying investments, we seek to operate at the more conservative end of the risk scale. So the businesses that we're looking at are perhaps slightly more mature than other funds. I think the great advantage of this fundraising into Downing ONE is that new investors will be buying into the existing portfolio that's been built up over many years, some of which under older rules when more boring investments were capable of being made, and consequently, as Judith explained at the outset, the mix of existing portfolios is kind of 60% in income generating stable businesses. The new money will be deployed in a mixture of income generating and growth businesses, but it's not going to move the dial a great deal. So the investors can look at the track record of the fund, which is delivering a consistent yield and performance, and buy into that really, rather than be investing in a whole load of new investments solely with sole exposure to investments that we're going to make in the future.
Great. And finally, I don't know who wants to answer this, but I'm going to invest in a VCT this year. Why should I choose Downing ONE?
I think for exactly the reason that I've just described, what Downing ONE offers is the diversification of the existing range of investments plus the new ones that we'll make. It's a big fund. This fundraise should take it over 100 million, which means it's very efficient. So our costs, the running costs of the fund, are relatively low as a percentage of the overall fund, and it's already generating a yield which will continue producing. So I'll certainly be putting some of my money into it.
And Judith, anything else to add?
I think it's pretty unique in the industry. It's one of the largest funds, as Jonathan has said, and you get that lovely blend of income generation stocks plus investments plus the AIM side, where hopefully we can get a bit of the sex and violence and growth and liquidity from that market. So I'll be investing too.
That's great. Judith and Jonathan, thank you very much.
Thank you.
Thank you.